Hi everyone, welcome back. Let's talk about PNB Housing Finance, which has delivered its fourth quarter numbers. NII and PAT has beat street estimates, but asset quality has worsened. We have with us Mr. Sanjaya Gupta, MD of PNB Housing, joining in on the show. Hi Mr. Gupta, good afternoon. While we are seeing that profits and net interest income, like I said, has come in above expectations, what led to firstly the lower disbursements and secondly the rise in NPAs?
Well, one is that the slowdown in the disbursement, especially in quarter four, happened as a continuous monitoring of the macroeconomic environment, and we really cut down on our corporate finance disbursements during quarter four. In fact, we degrew on the corporate finance quarter three versus quarter four by almost 37%, and we have been honoring our disbursements where the loans are already sanctioned or are partly disbursed. But when it comes to going new to the market, we are very cautious on the corporate finance because the new launches are muted. Plus, the marquee developers across the country are more focused on delivery rather than launching new projects. They have also condensed their credit requirement by doing more and more joint ventures with landowners. And in joint ventures, what happens that the project receivables pay off for the land consideration over the duration of a project life cycle. So, the demand for credit has condensed, and hence the offtake of credit has come down on the corporate finance, and I think it is going to continue well into H1 or quarter three of this financial year.
Okay, so you mentioned that you see demand for credit to be slower till at least the third quarter. So how do you seek to improve profits for FY20? What will be your key focus areas then?
Well, one is on the business. So the retail business is doing very fine, and we are a retail-focused housing finance company. 80% of our portfolio is contributed by retail finance, and that is the focus area, and particularly in 2020, the main focus will be retail. And I think we are going to be pretty successful there in 2020 as we have been in the last 8 years on our retail front. And I think on the profitability vectors, not only us but all the financial institutions are going to keep a very close watch on the costs, because look, the spreads, the NIMs, the margins are going to be market driven. So what is in your hand is cost control or cost measures that you are going to undertake and make your operations more and more robust and efficient, and increase your per capita turnover and hence protect your or insulate your profitability. So I'm pretty confident because our technology, our people, our target operating models are all sort of focused or honed towards retail business, and 2020 is going to be a retail year. I don't think it's going to be a corporate finance year.
All right. You're speaking about spreads and margins, but if we look at Q4 NIMs, it has improved on a QOQ basis, but it's declined on a year-on-year basis. So how do you see margins shape up over the next few quarters?
The impact of the change does not come on the portfolio overnight. It takes about 105 days for the portfolio to start reflecting that revision, upward or downward. And the reason for that is that most of the housing finance companies are on quarterly risk, and all loans are not booked in a particular quarter. So if you were to segment your portfolio every month, about 1/3 of the portfolio gets the impact of the revised reference rate. Plus, the demand dates are not on the midnight of the last day of the month. The demand dates for payments are stretched in the subsequent month from the 5th to the 10th of the month. So hence the impact of a reference rate change takes about 105 days at a portfolio level. And that is why if you were to see FY19, the first few quarters did show a compression on the spreads and NIMs because the impact of revision of these rates was not getting affected or reflected in the yield on the portfolio, which took time and got only reflected in quarter 4. They started showing their colors from quarter 3, but quarter 4 had a full impact on the revisions that we did during the FY19.
All right. Mr. Gupta, absolute gross NPAs have increased 6% sequentially, and you have presence in individual housing, construction finance, and some non-housing segments as well. So which of these segments shows increased signs of stress, and what's the outlook ahead, in each of these sectors?
Well, the asset quality is very robust, and first I will address the corporate finance book, because that across the sector is coming under a lot of vigilance, and a lot of anxiety is getting created. The gross NPA on the corporate finance book is only 0.17%, 17 basis points. The rest of the gross NPAs are coming from the retail book, and in the retail book it is not any particular product or segment. It is just that overall, because of liquidity tightening, because of GST, etc., what has happened in the regulatory environment, plus the seasoning of the books, is also getting reflected, and that comes to a gross sort of a NPA at an AUM level at about 44 basis points, at a portfolio level of about 48 basis points. Going forward, I don't think that the gross NPAs on the retail book are going to be north of 60-65 basis points. On the corporate finance book, we are keeping a very tight watch. We have created already, excess liquidity. We have used a lot of qualitative criteria. We have used a significant increase in credit risk criteria, which means that even on regular accounts which are not delinquent, you put provisions as per stage 2 for the entire life cycle of the loan. And 67% of our total ECL provisions are for the corporate finance book.
Let's talk about your AUMs. That stands at around 84,700 crore rupees. So how do you see this move by the end of FY20? And also you mentioned slowdown. So are there any specific pockets where you are seeing a slowdown come by?
So I will not be able to give you a forward-looking statement on the AUM growth, because we are a listed entity. I am not authorized to do that. But yes, when it comes to the industry or the market, the slowdown is primarily pretty observant in Delhi NCR for one, especially the Gurgaon area. Noida, Greater Noida, parts of Ghaziabad, etc. are doing fine. But overall NCR is pretty muted when it comes to growth rates. Otherwise, when it comes to the large markets like Hyderabad, Pune, Bangalore, Mumbai, they are on a steady state, and we are not seeing any volatility in the growth rates or in the the new business opportunities.
All right, Mr. Gupta, thank you for joining in then on ET Now and helping us understand what went by in the fourth quarter for the company. Well, moving away from PNB Housing, which by the way is just about at the day's high, 7.8% higher, to Jet Airways. Today, remember, is the last day for